verticals, especially life sciences, healthcare, pharmaceuticals, etc., they have continued to maintain the growth trajectory and are growing still at close to mid-teens numbers, going at about 13.8%. Most other verticals have been impacted in some way or the other by the overall economic impact of the pandemic. When you think about the trajectory that we had laid out, we are quite confident that from rupee terms, we should be able to get back to the same year-on-year number by the time we get to Q3. So we'll be year-on-year flat in rupee terms by Q3 from where we see it today. On constant currency terms, we will come close to year-on-year flat by Q3. That's our current expectation. And by Q4, we should be able to get back to year-on-year flat on constant currency terms also.
So the services, which is predominantly the IT services, have done reasonably well during this quarter in the sense that they were the best to adapt to work from home. EPC and projects and manufacturing just could not work because staff could not be present in the offices or in the sites. The labor were all under lockdown situations. In spite of that, if you see, we have booked nearly 24,000 crores worth of orders and produced nearly 22,000 crores worth of sales. Now, when you look at India, there are basically four buckets in which the spending takes place. The central government, the state governments, the public sector units, and the private sector. Normally, the governmental sector, that is the central government, state government, and public sector, used to have a capex of around 8 to 9 lakh crores every year. I guess due to the pandemic and various social and other direct benefit transfers and much other physical measures that the government has taken, there would be a reduction in capex spend. So they'll spread the spending over a little longer period than concentrating and trying to finish it much earlier like what they used to.
80% of our business actually addresses the health, hygiene, and nutrition needs of the consumers. And this part of the business has actually delivered a 6% growth. So while the overall comparable business was -7, it's important to call out that at least 80% of the business actually delivered a 6% growth, which basically means that due to supply chain lockdowns and supply constraints, and some of our out-of-home categories such as ice creams, food solutions, they were all impacted because of the economic environment and had a deep negative, which resulted in the overall headline numbers being -7. I think it's important to understand that because 80% of the business is well positioned and actually in good space.
From the month of May, which kind of largely catered to the pent-up demand in terms of which was there, we have seen progressively that the conditions have been much better. And in May, we were able to kind of do about 80% of our volumes of the previous year. And June was really strong from the point of view of getting a double-digit volume growth. And especially when we see the tier 3, tier 4 cities, they have really come back very, very sharply in terms of a positivity towards not only in terms of pent-up demand, but in terms of even fresh demand in terms of what we are seeing there. We are seeing the same trends in terms of July as what we saw in June. However, I think this sporadic lockdown, which I mentioned, is something which is a cause of worry.
As far as sales are concerned, definitely, yes, there was normalcy in the second half of May and the entire June. I would say that it was a bit better than expected. Could be pent-up demand, could be many reasons, also consumer behavior changing. And we also saw that consumer products did better than even the industrial products because industrial products were taking more time for the projects to restart and they were able to come back on the sites and projects. So we saw better traction in the consumer products. Continuing with the July, first week of July, also things looked quite stable. However, in certain pockets of the markets, things continue to go up and down because of the constant lockdown. So it's difficult to immediately say how, when, and how things will become normal.
We disbursed about 2,300 crore rupees worth of loans in the month of May. And then in June, we saw a more number of offices being opened. Mumbai, for example, was allowed to be opened from the 8th of June. So we started seeing a much bigger growth rate coming in from June. Foreclosure laws are possible in India. We go through a foreclosure process. It typically takes about 9 to 12 months to foreclose a loan. And because at that time, the average equity that the individual has in the property is so high, we would almost in every instance or in most instances recover not just the principal but interest. No, I do not think we will need to make provisioning at these elevated levels going forward. We made what we believe is adequate provisioning or more than adequate provisioning, taking into account the COVID situation.
June was more resilient than May, and May was more resilient than April. And as we've exited June, I would say we have certainly seen an arrest of any customer erosion. The erosion that we saw was largely in April and May on the lower end. That has now completely stopped. And we expect that we should start seeing some customer growth from here.
In June, the numbers that you saw as improvement had some pent-up demand, right? I mean, things slowed down March 3rd week onwards or 2nd week onwards. And then April, nothing happened. May, nothing happened. So there are some genuine, at least I'm talking of vehicles, tractors, all kinds of products that get bought in that market. So there were people wanting to buy, and they couldn't get an opportunity, let's say, between March to May. So I would imagine that the June number has at least about 25% of that number must have been a pent-up demand. If that was to be adjusted, then you compare June to July, I would think July is doing as good as June is. I would think as we all close March, the overall numbers compared to previous year could be around 50-60% of previous year.
I mean, the beginning of the quarter, I did say that it was going to be a tough quarter. It came up pretty much in the anticipated lines. Our revenues declined 7.2% on a constant currency basis. It increased about 1% on a year-on-year basis on constant currency. What was very exciting for us is we had very good bookings. Even in this environment, we could win a number of large transformational deals. We won about 11 transformational deals. The booking was more or less similar to what we had in the previous year, same quarter. Quarter aside, I think what is more important to look at what the outlook is, right? As I said, we're coming out of this with a good booking in the last 3 months. Our pipeline now is 40% higher than what it was 3 months back. So that's again giving us good confidence on the growth trajectory moving forward. We believe the worst is behind us. We are now guiding for an average of 1.5 to 2.5% quarter-on-quarter constant currency growth from Q2 to Q4.
I believe that when we are in a very high credit growth phase, then you have to be very cautious. And in a situation like this, prudence is something which you have to exercise. But for lending, in my view, this is the best time.